Hey guys, welcome back to the Independent Investor Channel. My name is Ryan, coming to you from the Big Apple, New York City, New York. It's so good to be with you again. Guys, this is what financial planning is all about, all right? This channel is a lot about giving guys information so you can feel comfortable investing on your own, guys. It's actually really simple to do. We talk a lot about the self-managed Roth IRA account as the very best vehicle for you beginning investors out there that are looking to tax protect money. I know a lot of people are looking at Robinhood as a first go at for investing, and there's a lot of folks out there that are in their mid-20s that are going out there and they're getting lured in by the temptation of free stock trades. Guys, the $6 stock trade, that's the least of your worries, all right? You guys are entering into taxable positions, and you're entering into positions where you're not tax protecting money and wealth preserving money going forward, guys, all right? So I would encourage you to take note. This particular episode is going to be for a friend of mine out there. This is going to be portfolio help. You know, this is for my friend Mike out there, so if he's paying attention, this is for you, man. This individual, just give you some of the background, in his mid-20s, got about $30,000 saved up, and has no experience in the market whatsoever. A few key things he talked to me about. He's really interested in investing. He knows it's the best thing to secure his future, and it absolutely is. He's absolutely right, but he doesn't know where to start. On my previous video on where to start, we talked about, you know, making sure that you're out of debt, and making sure that you've got an emergency fund set up, all right? This particular individual, he's satisfied both of those requirements, right? He's got $30,000 in the savings account. That $30,000 is a big enough amount to where he needs to start splitting that up and getting maximum benefit out of that money, all right? So where do you start? Where do you start if you're a young person and you're looking to invest? I find that a lot of people just kind of trip and fall and make their very first mistake, and they end up starting the wrong account. The wrong account, guys. Robinhood does not, they don't offer retirement accounts. They don't offer IRAs. And if you're starting your Robinhood account as your very first step into the investment world, guys, I'm throwing a red flag. That's not the way you do it. It's not the way you do it. All right, you guys really need to understand the benefits of passive investing over the long term to really get the best bang for your buck, guys, because the bottom line is making money. You guys want to make money? Listen to me, all right? Tax protect that money, wealth preserve it in a Roth IRA, a self-managed Roth IRA. And once you get up to that $5,500 and you guys can do that comfortably for a long-standing amount of time, then certainly you can start that brokerage account and start trading stock for free if that's what you want. I trade stock for free in my retirement account, and I've done it for years. All right. Once you meet certain tiers in those accounts and you've done the hard work of going through and starting accounts correctly, guys, I don't pay a dime. I don't pay the bank anything. I use their platform to get me direct access to the market, and that's it. I don't pay a dime. You want to know why? Because I'm the one in charge, all right? And on this particular channel, that's our sole motivation, is to empower investors to understand the dynamic benefits of alternatively investing on your own, taking control of your financial future and investing on your own, all right? So this is for you, Mike. Here's some free financial advice for you, man. Here's what I would do if I was in your particular position, all right? First of all, congratulations. Saving $30,000 is hard enough. We're all working really hard to get ahead in life. But what I see when I look at that $30,000 is actually an anchor. It's a detriment to you right now. It's actually being placed in a bank, and you want to know what the banks are doing with it? They're investing it, all right? They're making money off of it, all right? So you might as well spread those dollars out to give you the maximum benefit and not the financial institutions, i.e. the banks, all right? This $30,000, if I had this in the bank right here, I would start by looking at a 3-year time horizon here, guys. And for the first year, your maximum contribution to your self-managed Roth IRA is going to be the very first step. You got to get that started. I use Merrill Edge. I love them. They've been around for about 4 or 5 years. I think Bank of America bought Merrill Edge a few years back. I think I got started in 2011, 2012 time frame, and I love them. I've got enough money in there to where the incentives and bonuses have really taken a foothold, and I pay no fees in my account. Zero, none, zero, no fees. They get nothing from me. All right, I use the platform to get the exposure that I want, and that's it in the end of the day, and I can sleep easy knowing that I'm not sharing my money with everybody under the sun. All right, so we go ahead and we branch out here in year one here, and we max contribute. All right, now you can max contribute $5,500 all at once, or you can split that up per month, which equals $458 a month. So if I were you, all right, I would just take that $5,500 and I would contribute, and I would have that started in a self-managed Roth IRA account. All right, why? Because I'm giving you the information free, and if you do what I'm telling you, you don't have to touch the account ever again. All right, now in year one, we put this $5,500 in this account, which leaves a savings over here of $24,500. And you think, well, that's a lot of money, Ryan, right? I mean, well, yes, it is. But you got to remember, here's a young individual, right? He's probably saving for his future, maybe potentially looking to buy a house someday, all right? There's nothing wrong with having this savings over here. Nothing wrong at all. All right? You don't have to get overzealous. You don't have to go out and buy $24,500 worth of GoPro. You don't have to do that, okay? Put that money into your savings account and sleep easy knowing that you're making the right move over here in the self-managed Roth IRA account, all right? Now, this $5,500, right? Now we've got still a really good savings in year one, and he's taken the very best step that he can possibly take to securing his future by starting the self-managed Roth IRA account. Now, the pieces that are going to make up that preliminary account, guys, $5,500 is a really good accelerated amount, all right? They're outpacing, all right? For you folks that don't have $5,500 to just start the account, it's all right. That's all right. I started my account with $1,500. All right, so this guy's starting with 30 grand to sitting in the driver's seat. And if I was this individual and I was in this level of driving seat in my mid-20s, I'd be fired up to start investing. Because doing this right here, you're setting a foundation, you're setting yourself up for future. By nature of dialogue of talking to this individual, the one thing that really struck me is that he said, I want my money to turn into something grander someday. Isn't that amazing to have that level of insight at that age to say, you know, I know the potential of compounding interest. I know the power of money. And right now I'm not realizing that power of money. So I'm going to put that money away in the very best way. How do I do it? This is how you do it, guys. So you take that $5,500. I've got 3 assets that we're going to break up into that account in year one, all right? The biggest allocation in that account is going to go in the ticker symbol VOO, which is the Vanguard ETF, which is an exchange-traded fund that covers the broad index within the S&P 500, all right? That's going to give you instant diversification, all right? It would be irresponsible of me to recommend a single stock allocation if you're just starting out in the market, guys. You take the VOO, an expense ratio of 0.05, which in layman's terms is extremely low. It's like as close to you can get to free as you can get. 0.05, it's insanely low for the amount of diversification that we're getting, okay, for that low a cost, basically free. And we're getting a year-over-year return of close to 15%, guys, 15%. That's why we put this individual in this account, okay? We put him in this so that 15% average year-over-year can grow tax protected, okay? When this particular individual reaches 59 and a half years old, that year-over-year average has grown and accumulated tax protected within the self-managed Roth IRA, and it is wealth preserved, which is the niche of the independent investor channel, guys. Nobody else is talking about this. Nobody else knows what true wealth preservation is. And that means that I'm putting this individual, my friend, into this account, and he's not going to charge himself a dime. The financial institutions, they're going to charge him until that strangle holds that account over time. And when 40 years is up down the line, guys, they're gonna take their piece back, okay? And it's a big piece, all right? I've got financial plans and videos that talk about the damaging impact of fees, you know, on accounts as time goes by. A 40-year time horizon is going to render back to the individual investor, this individual, only 40% of their original money. In the self-managed Roth IRA account on this channel, the account we recommend, the individual investor keeps all their money, 100%, all of it. We don't have fees on this particular channel, all right? So in the very first year, we're talking about the Vanguard ETF, ticker symbol VOO. We're talking about going in ahead and putting a couple cornerstone stocks in this account as well. Stock number one is going to be Apple. Probably my number one stock of all time. Number one. The only time I've ever screwed up owning Apple is selling Apple. That's the only mistake I've ever made with Apple, is just not keeping it. All right? So I have no problem putting this individual into Apple for the next 40 years and letting that stock just run. Wherever it's going to go, it's going to go. It's got the history to back it up. And now we're getting a pretty good 2% dividend out of Apple because it's transitioning from growth to growth and income. All right? The third and last asset that we're going to put him in that last category to kind of diversify along the stock broader index, right? These are both Dow components, but Procter Gamble, one of my favorite cornerstone investing, play a nice healthy 3.5% dividend. The diversification within that one particular stock along their entire product line, guys, they're going to be valid and they're going to continue to be valid, all right? So these two cornerstone stocks now sets him up in this account to pay cash dividend on the VOO side, but also to start the dividend reinvestment program. Dividend reinvestment. Every single quarter, Apple, Procter Gamble is going to pay him a dividend every single quarter. And what do we want to do with those dividends? We want to take those dividends and we want to roll them right back into the stock again. So now we are dividend reinvesting in year one, and we are enjoying compounding interest in this account after year one. So congratulations, Mike. After your first year, man, you've got $5,500 in your self-managed Roth IRA account. You've got VOO, you've got Apple, and you've got Procter & Gamble. I can't build it any better than that. And I can guarantee there's going to be people that watch this video and they're going to talk about every other stock under the sun. What they do not talk about is putting that money into the correct account, all right? But I'm your friend. I got your back, all right? You put it in the right account, you're going to be good going forward, all right? Apple and Procter & Gamble, I'd love somebody to try to argue with me on that. I'd have a lot of fun with that. All right, now within year two, okay, we've had these assets working for us, okay? We've started that account. We're still building a firm foundation, all right? Building a firm foundation you cannot do overnight. It's not a wham, bam, thank you, and we're done. It's not like that when you approach investing calculatively and carefully. Becoming a passive investor is something that you do slowly and you approach it slowly and correctly. And the slower you approach it, the better off you're going to be building a nice sound portfolio for yourself that's going to be passive in nature, that's going to pay you that long-term wealth that you're looking for when you retire someday, okay? Now in year two, we start to compare what happens here. This 30,000 is going to drop to 24.5, and then after year two, we're going to max fund our Roth IRA again, our self-managed Roth IRA, all right? So we're going to max fund this Roth IRA over here. We're going to drop down. We're still going to have a nice, healthy savings account. There's nothing wrong, again, with having as liquid a cash as you can possibly have. $19,000 still at year 2. So you're sitting on a pretty good amount of cash, but we're still working our magic over here. We're working our magic. We're looking to build that account, guys, right? All right. Now, look what's kind of slowly happening here. We're transitioning from hard-earned dollars to tax-protecting dollars over here within this self-managed Roth IRA account. Now, we still have our cornerstone pieces in here, all right? But in year 2, we're going to add more to the VOO, Vanguard S&P ETF, our diversified ETF product. We're going to add a couple more cornerstones to that account. Now, congratulations, you're a shareholder in Apple and Procter Gamble. Guess what? We're going to look at a couple different sectors. We're going to look at the financial services sector, and we're going to look at the consumer discretionary sector. Do you see kind of why we do that, right? Do you see why we don't jump right to a Facebook? We're already invested in technology. We're already invested in consumer staples, okay? So we look to broadly diversify over different sectors in year 2, okay? So we're adding to our position in VOO, all right? We're adding a Disney, okay? We've all heard of Disney, right? Do you need to look over and scour over balance sheets and income statements to know that Disney is the right investment for you? Nope, you're good. Go ahead and buy Disney, you're good. Go ahead and buy it in this account and tax protect those dollars for the legacy that you're going to build over the next 40 years, all right? And we're going to add JP Morgan Chase, the largest bank in the world, all right? Pays a monster dividend, not going anywhere, and it's going to continue to pay you as a shareholder going forward, all right? So this is the completion of year 2. And you see what's kind of going on here. After year 2, you've got $11,000 of sound assets going on here, right? And as long as you stick to the plan, okay? On a lot of my previous videos, I talk about sticking to the plan. Once you buy these assets, the best thing you can do is close the book on them and let them ride going forward, okay? Just let them ride. Let them work for you. The longer you hold on to these assets, the harder they are going to work for you, all right? The harder they are going to work for you, all right? Now, again, Disney pays a decent dividend, just less than 2%, but JP Morgan pays a monster dividend of close to 3.25%, I believe, all right? But still with the same theme, and we're going to set these up for dividend reinvestment going forward, all right? Now, instead of 2 machines, we've got 4 machines working for us within this account. And guess what? Who are you sharing your money with? Oh, yeah, nobody. It's all yours, okay? Now, on year 3, the final year of this preparation of getting this $30,000 broke up in a strategic, correct, responsible manner for you, we're going to go ahead and drop down. Now here we've got $13,500 still in your savings account, okay? But look at what we've got over here. Look at what we've built. We've got $16,500 put away as a foundational portfolio beginning. But look at the assets that we've got in this. Now on year 3, VOO should be established as your main ETF going forward. So what we're going to do here is in year 3, based on your age, and now your risk tolerance has increased because now you're an experienced investor. What we're going to do here is we're going to continue along the stock diversification spectrum. And we're going to add a Johnson & Johnson. We're going to add a Duke Energy. We're going to add a UTX, United Technologies, and we're going to add a Verizon, all right? Now, these 4 are going to continue along the diversification. J&J in the pharmaceutical or the healthcare sector. Duke Energy is going to give you that utilities exposure, pays you a monster dividend, 4% a year. All right, to give you that rolling dividend reinvestment, and it's going to give you that compounding interest that you seek, all right? United Technologies, one of my favorite industrial. I've got a lot of favorite industrials, and quite frankly, I could give you 10 others that you could win with. 10 others, guys. It doesn't really matter about the particulars that make up these accounts, all right? All that really matters is the type of account you are in. And I would love somebody to try to challenge me on that because the mathematics back me up, all right? Now, finally, Verizon. Verizon pays close to a 5% dividend, all right? So from year 1 to 2 to 3, We are building out a portfolio to start generating and paying us, all right? Now, just in closing here, after this $16,500 just represents your contributions up to this. So it's just a little over half of your initial $30,000. So we're just over half after the beginning of year 3, after you've contributed that. Now, $16,500, what if it ends up going down $2,000 or $3,000? Is that possible? Sure it is. Investing, there's no guarantee in investing, none, all right? But what if this $16,500 turns into $20,000? What if it turns into $25,000? Does it really matter in either case? Does it really matter? So many people think that they have to just start investing. There's so many videos out there about how to invest your first $1,000. I just don't get it. I don't get it. What people are going to do is they're going to put it into Robinhood. They're going to go out there. They're going to buy a stock. They're going to get themselves into tax trouble, and they're going to get themselves into trouble as far as not having your money in the correct account. You're going to get yourself into trouble, guys. This right here is a sound way of approaching the market, and this $16,500 really is just, all it is an arbitrary figure to represent what your total contribution level is up to this point. But if you're investing for the long term, if you're investing for the next 40 years, this amount doesn't matter now. It doesn't matter over the course of a 3-year spectrum. You want to know what matters out of this entire example? You've taken this $30,000, you've entered into it a tax-protected vehicle. You've put yourself in the very best of breed with regard to single stock and risk control and allocation. You've diversified along your stock spectrum, and you've diversified along your ETF spectrum and get you that broad-based diversification within that account. And you've actually got this starting to build a sound foundation in your self-managed Roth IRA account. Now, what you do after year 3, give me a call if you'd like. You really wouldn't have to touch this again. If one of these years you didn't have this entire $5,500, maybe you wanted to reduce that, you don't have to invest it all at once. You could kind of split it up over the years. But this right here answers your single question of what do I do with $30,000 in the bank, all right? And I hope this really draws a clear picture. Now, finally, I would just like to kind of add, something that we can kind of earmark as a goal for this account going forward at some point in the future. There's a couple stocks that I didn't name in this account, and there's no guarantee that maybe within the next 3 years or something you're not going to get married or take on a spouse, and then this is going to double for you, which makes you double the investor. All right, there's a lot of benefits of having 2 accounts within a marriage that are speaking to each other. But for now, I just earmarked Facebook, Microsoft, Citigroup, and Pfizer, and then maybe looking to add an index fund, right, which is kind of like a mutual fund. It's kind of like an ETF, just with very, very low fees, and it gets you that broader based diversification, something that as your account builds, you can have 40, 50, 100, 100.5, $250,000 in this nice index fund. Again, from Vanguard, the same company that offers the VOO, look to add an index fund into this self-managed Roth IRA account. Guys, listen, I hope you enjoyed this video. This is a breakdown of Mike's portfolio help. I hope you enjoyed it. Listen, if you haven't subscribed to the Independent Investor channel, I encourage you to do so. Please hit the subscribe button. You'll be notified of any future videos. If you have ideas for me, or if you have your particulars that you'd like me to break down for you and give you some investing ideas and think you might be able to benefit from some of this information, please leave those comments in the bottom of the video, as I do review those and I give detailed replies to all of my commentary. Guys, hit the thumbs up button, share the link with anybody that you know that might be in the same position as my buddy here, with a lot of money in the bank and really not a whole lot of wherewithal to know what to do with that money. Guys, again, thank you so much for tuning in, and good luck in your investment futures.